All right, guys, we are back for another episode of the BLD Financial Podcast. And today we have the pleasure of having our good friend Michal Wach, real estate tax accountant, real estate investor, JV partner, overall great guy. Thank you for coming on.
Yeah, thanks for having me, guys. Glad to be here.
Yeah, we've had the opportunity to be able to kind of grow, with you. I mean, we kind of got into the business kind of roughly the same time. You were coaching. We've run in the same circles for a long time. Mike has been around, I guess, as long as we've been doing it for. Mike, why don't you tell people a little bit about what you do, how you do it, how you got here, what's going on?
Yeah, sure. I guess it all started around 2008. We bought, me and my wife, our first rental property in Hamilton, a single family home. Our only goal was to have tenants pay off one mortgage for us so that, 25, 30 years later, we'd have our own property paid off and tenants paid off another one for us. And then over the years, it just kind of, we had an opportunity to refinance that property, buy another one and another one. Then I found some kind of coaching groups along the way with Rockstar Real Estate, the whole investor community here in Southern Ontario. And since then, we've, grown our own long-term real estate portfolio. We own a luxury cottage in Muskoka, so that's kind of its own business or silo, if you will. I've coached real estate investors, had an opportunity a few years ago where that came up, so I jumped on it. And then I've kind of leveraged that into what I'm currently mainly focused on, which is the tax business. And I focus on working with investors and self-employed individuals. So it's kind of been a natural progression building on, different skills and networking that I've built up along the way to grow both passive income streams and active income streams.
So what I hear is you saw the pain and suffering everyone went through from 2008, now to today, and you're like, everyone's going to need a really good tax guide to help solve all these issues. Let's get back in the game. Let's focus on that. Help everyone. I mean, it's starting in 2008, obviously you've been through a couple different, market cycles. I think it's important for everyone to, understand real estate, and I'm sure they obviously do. Like, real estate isn't easy 100% of the time, right? You have some really great ups, but you have some really bad downs as well too. What have you seen just from the time that you've been in there in terms of like the cycles that you've gone through, and like what are a couple of things that you've kind of taken away and be able to apply to your portfolio now and just your investing strategies like moving forwards?
Yeah, it's a great question because especially timely right now, given that a lot of investors are struggling and, going through not so great times. I think for the first 7, 8, 9 years, things were very stable. Like, we just had the one property, then we bought a second rental, maybe 7 years after the first one. But I remember looking at my mortgage pay down and on my cash flow, and it wasn't going up or down. It was just very gradually increasing. And I think that's kind of like what real estate maybe should be like. We shouldn't have these highs and lows, every 2, 3 years, or at least that's what we got used to. So we had like the neutral growth, right, for about 7 to 10 years. And then in 2019, 2021, when we acquired a lot faster, the market was just crazy. Everything was on fire, right? And now, so we saw the good times, and now the last few years, things have really crashed down to earth. And as we were chatting before, you're kind of looking around to see who's still left standing, who's been able to keep things afloat with, hopefully they bought good assets or they have active income streams to kind of keep them afloat. So I think I've seen all kind of both ends of the spectrum and everything in between just in the last 15 years or so.
Yeah, I mean, I think real estate investing got almost sensationalized. It became the hot new thing. If you could literally, fail on a project and make money for, a few years. It wasn't, everybody thought they maybe, were the smartest person in the world when they could buy a property. The next day it would be worth $50,000 more. But you're right, stability, real estate is more of a get rich guaranteed kind of situation. It's a stability thing. It's a monthly pay down on your mortgage, slow appreciation of your asset over time, well managed assets. And I think that as you go through market cycles, those lessons are learned or either brought with you, but unfortunately there are hard lessons to learn as well. If you bought, I think right now Toronto is trading at 2020 prices. So, half a decade of price appreciation wiped out, and with, you're still seeing softening, valuations across the board. So definitely something that I think, I don't take for granted that we worked through. We've had the opportunity since we started. We haven't really had a normal market. We kind of got into it right before COVID, and then low rates, and then high rates, and then inflation, and then now this. So it's interesting watching.
Whatever this is,
Yeah.
middle ground of melting of just everything coming together.
Yeah, it was. There's always opportunities in instability, but stability would be something nice to finally one day have. I don't know if that's necessarily going to happen with the volatility and then how maybe some of these levers are being pulled behind the scenes with like the Bank of Canada and whatnot. You kind of have inflation that's running away from us, and you're using economic factors to be able to change that. There's a lot of people who believe that you're going to have just swings up and down, and stability is going to be very difficult to be able to create again.
Yeah, I think we all as business owners, investors, whatever else you are doing to make money need to be okay and expect those swings now. Gone are the days like, those first 7 or 10 years where I wouldn't even pay attention to my statements or my mortgage info or my interest rate because nothing was changing. Now, every CPI or employment report, you're like, people are panicking one way or the other. So it's definitely changed. Everyone just so much more connected and in tune with what does this event or this announcement mean for my family and my grocery prices and my investments.
Everybody becomes an economist. It's actually wild how many people know what CPI is now, and people are tracking job numbers. The average person you talk to, like, oh yeah, CPI is coming out on Thursday. Are you gonna catch that? I'm like, oh yeah, it's like catching a hockey game.
Well, that's the social media effect, though, right? Is like, you get the knowledge flow from the guys who are higher up or more in the know, right? You start talking about the key points. And then you get the postings, and then the mid-level guys, the coaches, catch on to it, and they pass it down to the the newer investors, and it becomes more, and like we were talking about earlier too, like just before shooting this one, like if you're an investor, I mean, you got to start learning like the KPIs of the economies, right? Especially when you're getting into like the commercial real estate game, understanding the types of things that are going to impact movement on the Canada mortgage bond. If you're your closing is coming up in a month. Like, is there some sort of rate announcement coming out? Is there some sort of like unemployment numbers coming out? Is there some sort of like inflationary data? When is that coming out, before or after your expected close date? Because like those could all come, they could all have a huge impact on where your final numbers end up. Are you potentially, are you already in a buy down situation, and is it going to potentially get worse? Should you look at trying to lock that rate in quicker? Are you right on the edge of a buy down, and maybe if you wait like a couple of weeks for an announcement, those rates drop, and you don't have to have any sort of buy down on your closing? So like being able to understand the kind of like the KPIs of the economy and these indicators and how they're going to impact the bonds and the overnight rates and all that stuff, like it is an important thing to learn, especially getting into the commercial side.
Yeah, and I think that's why I enjoy the business that I'm in, the tax business, because it's very stable, and I'm a conservative individual at heart, and who happens to invest. So I kind of put my butt out there for years and years, investing in things that maybe the average person feels like is a risky move. But I always love dialing it back and going back to, hey, everybody needs to file a tax return once a year for their corporation or their personal taxes. There's strategy involved in that. There's more and more people want planning, but that really brings me back down to earth and grounds me in this crazy, exciting world and economy that we're living in.
I agree. I think that, let's chat about taxes. And taxes, probably the bane of every real estate investor's and high income earner's existence is, every single year you have to pay your taxes. But inevitably, unless you have something in the Cayman Islands, you can't get away from it. So, as a real estate investor in Canada, tax strategy is probably one of the most overlooked things, at least in my opinion, for smaller to mid-sized guys, because they either get bad advice or they don't want to pay the money for quality advice up front. But when the tax man comes calling, it definitely is something that should be probably in the forefront of a strategy instead of on the back burner. I mean, you obviously have different levels of people coming to you. What are some of the major mistakes you're seeing investors make, getting into, whether it's just buying a first building or buying a first house or as an investment in general? Like, what are those things you're seeing?
Yeah, it definitely is a pain point in general. And I think as a business owner, I feel very fortunate to be providing a service and helping in an area where the average citizen or Canadian does struggle in, right? Financial acuity, we've been saying for years, it's not something that's really high in terms of teaching in school. So a lot of people don't understand debt and taxes and mortgages and interest rates when they graduate, and they need to run a household and then maybe invest in a house or two or other assets. So I'm more than happy to be jumping in there. Once somebody comes around and realizes, hey, you know what, I should probably be asking, like, I don't know what I don't know, I should be talking to an accountant. So when they do reach out, some of the issues that I see, number one is definitely unorganized bookkeeping. A lot of people just, and I don't blame them. Like, these are realtors, these are successful business owners, flippers, long-term rental investors, construction workers, anybody and any type of strategy or any type of assets that they invest in. Some of them really struggle with this because they're really good operators and business owners, but they don't understand, like, hey, should I be incorporated? Do I need a payroll account? How does HST work? Like, when I sell this short-term rental, what are the taxes or HST implications going to look like? So bookkeeping is definitely a big one. I'm definitely finding more investors, more clients expect strategy, and like, they want to have access to you. So I think that's something that individuals that maybe start working with an investor focused accountant for the first time, or a business owner focused accountant, really don't know like what they were missing out on until they start asking, just a couple of questions that they think they should be asking. And then I kind of put my business owner hat on and I say, well, have you also thought about this and this and this? And now we're talking about helping them grow their business, or helping them maybe streamline their rental portfolio, and they should sell a property or two, versus not just how to save taxes. I've had just too many individuals reach out that are way behind, like 3, 4, 5, 6 years behind on filing personal, corporate, GST, HST, but also behind on making tax payments. It's something that once you fall into that rabbit hole, it's really hard to get out of.
Well, it's like private interest money or private lending money. You're what, 8%?
It is, yeah. I think right now it's 7% today, but it's been fluctuating between 6 and 10 for the last few years.
Yeah, that's, it's a
Not cheap.
never-ending pit of interest payments if you can't keep up with the actual payments.
Yep, for sure, for sure. And I think, a couple of success stories that I'm most proud of have been the small percentage of individuals that have been able to get out of that hole, because it's just tough. And unfortunately, it starts affecting you personally at home. Like, it has impacts on your family. You can't operate at your full potential at work, in your business, whatever you're doing, whatever assets you're trying to grow, when this tax debt or these late filings, unfiled filings, are kind of gnawing at you in the back of your mind.
But I think, like you said too, like, everyone wants strategy, but strategy is implemented ahead of time. It's hard to be, behind on taxes and say, okay, how do I strategize to, make this all disappear? Like, at that point, it's more like, hey, let's get this cleaned up and, dealt with, and then we can look at getting into strategy to help move forwards. But I'm assuming, pretty hard to implement strategy when you're retrospect versus like initially getting into, your first tax filing and moving forwards.
Yeah, there's been many examples where we've tried to do both at once. So for example, someone might be behind 3 years on their personal taxes. They own 2 rentals in their personal names, husband and wife, and they have a sole prop, and they're behind. So we're going to help them catch up. But in that process, I tell them, hey, you know what, you might want to incorporate, because you're making $150,000 for the last 3 years, 4 years. Let's catch you up, but at the same time, set up this corporation ASAP, set up an HST number for the corp, because, assuming in their scenario they don't need all of that money from the corporation, from their active business to live off of. They have other income streams. Maybe the wife has a T4 job, or their properties or other assets are generating income. That's a great candidate for a corporation, or whatever they leave in the corp, they're paying the small business deduction tax rate, 12.2% in Ontario, the lowest tax rate you'll find anywhere. from income that you earn, as long as the money stays in there. So there are times where we can both help clean things up, but also strategize and plan forward.
Yeah, and I mean, you know, as a commission, person, structuring before you obviously start to make, large amounts of commission, it's always, hindsight's always 2020, but I obviously highly recommend doing it. But when it comes to, corporate structure, I think, people get some bad advice. I think people just get told, oh, just keep it in a corporation. It's not going to be on my personal tax, or it's not going to show up in my credit bureau, or, keep it in a corporation. The banks don't have to use my income to qualify. I think that there's just a lot of, locker room talk around corporations and when to use them, when not to use them, specifically for commercial real estate. We always recommend a little bit more robust, I guess, corporate structure. You would have, multiple or individual corporations for every asset, holding corporations and possibly family trusts, depending on how large your investment goes. But when you're looking at that structure, it's also when you're like a newer investor getting into this, it's important to understand the cost of actually operating, a structure like that. Depending on how large your accountant is and whatnot, it could be between $5,000 to $10,000 a year for, filing your taxes. It's not just like something little light that you should just do because someone told you should do. Obviously, talk to an accountant about that structure.
Yeah, I think a lot of individuals want a simple black and white answer. They want to know, should I incorporate or not? What do you usually tell investors like me? And often I feel like a lawyer, because it really does depend on where they are now, today, with their income streams, the assets that they hold, the type of properties, and also what they're buying next, what they're going to be growing into. So if you're just an average small investors with a couple of duplexes or a triplex, let's say 2 to 3 properties in your name, and you still have a T4 job, your spouse has a T4 job, and they're not generating a lot of cash flow. Once we factor in all the expenses, we can throw in depreciation if we need it to bring all the income down to zero any year as well. I probably have 25% of my clients that depreciate their rentals, but we can eliminate all of that income. In that case, buying that third or fourth property in your personal name, there's probably nothing wrong with that. Keeps things less expensive. You pay less for your taxes at tax time. You probably don't need a bookkeeper. Most of my personal tax clients don't have bookkeepers. It's just less headaches. Yeah. Financing, as you guys know, might be a little bit easier. You might have some more options with lenders. I like to take a nimble approach, right? There's a time and a place for corporations, multiple corporations, family trusts maybe. But in that case, just kind of default and you might be okay. But I do want to reassess that every 6 or 12 months. Like I tell my clients, if you're going to be buying something else, let me know. Because if they want to buy a laundromat next, or a 6 or 10 or 12 unit apartment building, or a short-term rental, cottage, I might be giving them different advice than for that duplex that they told me they were planning on buying next. So most investors I see that are, moving into the larger multifamily, I'd say 5, 6 units and more, or you're buying an active business, or it's like a storage facility, anything along those lines, you're probably now looking at the corporate route. You don't want to typically hold assets and earn revenue from those sources in your personal name. You want to have that kind of divide there. And if you're doing with partners, now that's where the discussion with your accountant and your lawyer comes in to say, do I need multiple corps? Do we want one corporation to own the asset or the business? And then we each have our own respective corps that's going to pull out when we want to any profits, right? Any money from that corporation. So now you get into different levels. Family trust is like the next level up, right? I'm not going to claim to be an estate planning expert. In most of my discussions with other corporate accountants, other folks in the arena, family trusts, I'd say work, this is my opinion, for a very small percentage of people. It's like literally 1 or 2%. And you are paying money to set that up. Now you have multiple corporations most likely that you need to maintain and upkeep and keep everything organized. So you really need to be sure and clear that for you and your family and any children that you're setting this up for, whatever the reasons are for their large portfolio or the large active business that's going to be growing over the years, that it makes sense.
I feel like the only one who has fun in the trust fund is the baby.
Yeah.
That receives it all. Like that's, he's really just the guy in the best spot, just scooping it up. But like real estate's an interesting thing because, you're gonna buy a property, you're gonna put it in a corp, but you're gonna have like 3 different opinions when you get into it, right? You're gonna speak to your accountant, you're gonna talk to a lawyer as well too, and you're gonna talk to your mortgage broker, and everyone's gonna have a slightly different opinion on what you should and should not do. Sometimes it all aligns, but maybe for like different reasons, right? When you get into multifamily, you get more doors. Your legal risk goes up as well too, right? Like most lawyers are probably gonna tell you to buy it in a corporation just to protect yourself. So I mean, like it's an interesting thing, and you really do have to speak to all of your, like your 3 pillars of getting, like of real estate and understanding like from which aspects are things going to, like what are the implementations they're going to have on your project, but also like carrying forward, what does that look like, right? Like if you start buying, as I see some investors do, 1 or 2 projects in a corp, they open up a new one, and they just start doing that over and over again. I mean, the corporate financials and stuff, like when you're looking at it from a commercial like perspective from the financing, like you have to have like your financial statements, ideally some sort of like notice to reader. Like there's an annual cost to having this as well too that not a lot of people talk about. And again, like when you get into the nitty gritties of some of these like 5 to 10 unit buildings, you're buying with CMHC, MLI Select, you're getting rated on that 1.1%. You're not necessarily thinking about, okay, now I got to like manage the cost of all these corporations as well too. Like on top of any sort of like unforeseen maintenance costs, like that can really start to eat away at any sort of like leftover profit at the end of the year as well.
Yeah, it's true. Like one corporation in Ontario will cost you, $1,500 to set up with the lawyer. Your annual T2 tax filing might be two and a half thousand. Your bookkeeper, because you probably need one then, unless you want to be playing around in QuickBooks Online or another software, will be 2, 3, 4, 500 per month. So you're adding 5, 6, 7 grand to your expense line. And if you have 1 or 2 assets in that corp, or it's an income stream that is 60, 80, 100 grand, you really need to factor and weigh those. How much do I want to really need to keep this off my personal name? What is this corp going to be used for? Maybe other purposes in the future, 100%. And I'm a professional skeptic. I think that's why, as an auditor in my past life and as an accountant, I question everything. I had so many calls with accountants and mortgage brokers and lawyers before we set up some of the structure that we have. We have a couple of corporations. We've claimed a lot of things in our personal name, but it's all been done, with a specific goal of like, I know, hey, here's where I am right now. We were pretty clear on where we were headed. And that allowed me to, sleep at night knowing that I think I landed in the right spot here. This is in the personal name, this is in this corp, this is in this corp, but it's definitely a tough decision. Like you said, you got to talk to your power team, Aaron. And unfortunately, the buck stops with you at the end of the day. You need to clean all that up, put into ChatGPT, and make a decision on what the right balance and structure is for you.
It is like, it's funny from our side, I suppose. But I mean, at the end of the day, like, regardless of what your accountant or your lawyer says, like it really comes down to like, what is the lender, how do they want that and need that to be structured to get, your mortgage? Like you might get all the, the opposite advice from your other professionals, but unfortunately, at the end of the day, it's whatever the lawyer says goes.
Well, that's usually what happens is nobody actually gets along. Your accountant and your mortgage broker and your lawyer all have different opinions. One's worried about your finances, one's worried about getting a loan, and one's worried about liability.
Yep.
It's you coming together. It can be a challenging thing.
I hear you. And I think what clients appreciate is that I'm very unbiased. Like I will give them the pros and cons, and I'll provide them additional insight on why the mortgage broker might be telling them to incorporate for your first A unit purchase, because you're dealing with a partner and like they know what income you're earning on the personal side. I'll explain to them why the lawyer might be saying this and this, and often clients can see through that when you're a biased professional and you're trying to sell them something because that there's money in it for you every single year for the T2 or for the annual resolutions or whatever it is with the lawyer. So I think when you just come from a point of honesty and truth, clients will definitely appreciate that. And that's
I know one conversation I saw a lot of, this is more when we were doing a lot more like the res stuff, but for like business for self individuals, like how much are you going to pay yourself and what does that look like getting a mortgage? And then, what are the cost differences of paying yourself more and paying the taxes on that to qualify with, like an A bank versus paying yourself less, taking less taxes, to qualifying on a B lender, right? You're gonna have some more fees on the B side. Your rates can be a little bit higher, but what does that look like compared to paying, tax another 50 to 75 or $100,000 to be able to get you into a slightly lower interest rate? Like, saw that conversation a lot. Obviously, the accounting side is going to have one opinion. Again, there's going to be another side there, but I think that, if we're looking at like important times to have that conversation, or just like certain conversations that come up, that was a pretty common one that I saw a lot of.
Yeah, it's all about being proactive and perfect when clients are having those conversations ahead of time versus somebody going, on an online website and creating their own corporation with their own shareholder register and kind of flying by the seat of their pants, connecting with your power team members and truly understand why you're setting up a structure. I've seen multiple examples where an individual incorporates for whatever reason, and they end up needing all that money throughout the year, like for 1 or 2 years, and they take it all out. So they have to claim it as personal income. They end up with a really high personal tax bill because now they're paying tax on 125, 150, 200 grand. They were never truly explained what it means to have the corporation, but when you pull everything out personally, you end up paying the same amount of tax as if you had just claimed it as a sole prop, for example. They thought, no, the guidance I got was to set up a corporation. I'm going to pay way less tax, like 12.2%. But no, if you pull it all as T4 dividends, like that's not happening. It all gets, like the tax system is set up so that there's no true benefits in terms of taxes of earning money this way or this way if you end up benefiting from all of it. The corporate structure allows you to defer taxes by initially paying that low small business tax rate on anything that you leave in the corporation. But the CRA wants their money sooner or later.
They always want their money.
Yep.
The pound of flesh, But I think all the conversations that we are having all inevitably go to taxes. How do I optimize my paying less tax? How do I do it properly in a corporate structure? There was a few big headlines that came out, I think this year or late last year, on the capital gains tax. Now it was happening, and then it wasn't happening, and then Carney said it wasn't happening. What is happening?
Yeah, that was a bit of a kerfuffle. I mean, just like maybe some other government announcements and initiatives over the last few years.
Yeah. Carney-fuffle.
Yeah. So yeah, it really, probably scared a lot of people. It insinuated anger in people. I remember a lot of folks when the 66.6% capital gains inclusion rate was announced, and that if you owned assets in a corporation, that was going to be applied from the first dollar, I believe. And so it past a certain date. So individuals are trying to sell assets, properties that they own in corporations by that date, so that they still only had to have the 50% inclusion rate, which is unfortunate because it all got kiboshed. So now you sold assets that maybe you would have liked to hold. But you know what? It all kind of blew over. They scared us for a little bit. Accountants spent a lot of time planning and trying to mitigate clients' tax burden and trying to reorganize things. And now investors in our community were saying, should I buy my next property in a corporation and have a higher capital gain when I sell it down the line? Because personally, it would have stayed at 50%, right? So it was very interesting time, but all kind of blew over. And now, as far as I know, it's business as usual. Any capital gain that you have, whether it's a crypto sale or a stock sale or a real estate sale, 50% is included as a capital gain, and then you get taxed at your marginal tax rate. So I think in general, investors, I think, overestimate how much they owe in capital gains, I find.
It's like a terrifying nightmare that everybody thinks about. And then
I was just going to say, maybe chat about the difference between the inclusion versus just a flat. Because I think people don't understand that, where they don't understand how tax is actually being implemented on their income versus, they just see a number at 50%. Am I being taxed 50% across the board, or is an inclusion on 50% of what I claim? Maybe touch a little bit on that.
Yeah,
especially with the capital gains.
Sure, it's a good question because it can be confusing. You see the top number of the profit that you made on your property that you've held for a few years or a decade, and then you hear about the inclusion rate, and you might be a decent salary earner, and you think, wow, I'm going to pay a lot for this in taxes. So if you make, let's say, $100,000 capital gain, like you sell something that you bought for 200,000, you did no improvements to it, that's your cost base, you sell it for 300,000 and you own it alone personally, your capital gains 100,000, half of that is taxable. So 50% will show up on your personal tax return as a taxable capital gain, and then that's further multiplied by your marginal tax rate. If I had to generalize, many of my personal clients have a marginal rate of like 20 to 30%. So now we take the 50 that's taxable, multiply it by 20, 30%, you're only actually paying like 10, 15,000 of tax on that $100,000 gain. Obviously, if you're a higher tax earner in a higher tax bracket, that rate's going to be a little bit higher, the taxable portion. But then if you're selling an asset that you could maybe sell with a vendor take back, that allows you to smooth out that capital gain over the term of the VTB. So I see that sometimes with family members, like when you're thinking about planning forward and one of the parents doesn't need all of the money in that year, but they want to pass that, property on to a child, they can use a VTB structure where they smooth out that capital gain over 3, 4, 5 years. Because then that, doesn't impact the parents' taxes, especially if they have any government support that they're making. It doesn't get grind down as much. So there's definitely strategies. If you work with an accountant, then you kind of come to them ahead of time. I have a lot of clients reach out to me for estimates on capital gains because they want to know, like, hey, if we list this duplex that isn't serving us well anymore, what's the damage going to be? And they want to know, is it 100,000 or is it 20,000? Because that might sway them whether to list or not.
Whereas alternatively, if you did the same thing in a corporation, you had $100,000 gain in your corporation, same thing, you're at 50-ish%, and then you get taxed at the same thing.
Yeah, it'll be the same way. Like whether you incorporate or not, for active income or for holding passive assets, the tax implications are almost identical.
Except you need to pay tax again if you take out any profit from your corporation.
Yeah,
So you're paying tax twice.
Yeah, so in that case where you own passive assets in a corporation, it gets a little complicated. I don't want to get too far in the weeds, but when you pull that money out of the corp from that original sale, like it's just sitting there, right? The corp has the money in the bank account. You're going to pay money on that on your personal return, but then you're going to get a refund, the dividend taxable refund on hand in the corporation. So it's kind of balances out. You pay personally, but you get a little bit more money back in the corporation.
Gotcha. I mean, I think maybe they intentionally make it complicated. Like it's kind of like CMHC, if you can, they make it complicated for a reason. The bar is high, but I mean,
there's a lot of things you can kind of figure out as you get through it. Like being a businessman, like you can kind of figure out business and sales and how to run a corporation, but like tax code's like the farthest thing down the line that you can kind of just like naturally pick up and learn as you go through it. Like it's kind of hard to just like, I'm going to muscle my way through this tax year and I'm going to figure it out as I go. Like I obviously probably wouldn't recommend, I'm sure you don't recommend it either, but it's just like, there's a lot of stuff they don't teach you in school. That tax code's like all the way down the line. I feel like it's like, unless you're going specifically into some sort of like CPA accounting, like you're not even really touching tax code at all.
Yeah, but I do like clients, that come from the perspective of you, Aaron, where they want to come informed and educated and be pitching strategies and say, hey, I saw this from a guy on YouTube, or I read about this, or a friend of mine, heard about VTB and minimizing taxes. But that's a smaller percentage of the clientele I have. Most people just want to be hands off, and
this is a scary thing, I think, for people to.
It is. It's and the CRA's gotten more aggressive. They want their money faster, sooner. They want reporting to happen. If you fall behind, on your HST return, if you're a new business owner, 6 months later you don't file, you might get a phone call or a letter like, "Hey, we know you registered. Where's your HST return?" Like they've never been, at least in the time I've been practicing, this aggressive. And then some clients literally, I mentioned to you guys briefly, they will just forward me email notifications when they know that there's a CRA letter in their CRA My account. They don't even want to open them. They're like, Michael, here, can you read this and let me know what I need to do? And if there's something to be action, can you that's the fear that exists there from clients.
Like your mom reading your college acceptance letter.
Yeah.
Like, just tell me if I get in or not.
It's
like,
funny
am I good?
when I come home. So my wife checks the mail, and then whenever I go home, and if there's like a stack of brown letters, she'll just have like a beer beside it. You know, when I get home, that way she knows it's like, it's okay, just drink the beer, open the brown letters. I'll try to open them last, but you know, they always, you know, I guess, you know, my grandma always said, death and taxes. So if you can't get around the taxes, then, you know, understand how to play the game. And I think that's the most important thing. Is there's still a lot of people who are working in real estate who are extremely high income earners, or people who are still investing in real estate who are able to make a ton of returns. So just finding the most tax efficient way to be able to do something it's no longer like you know, an option, but a requirement to be able to get ahead, because you know, the taxes, navigating the tax code, navigating all the taxes that are coming up, even, you know, we'll touch on the short-term rental stuff, but you know, even just like navigating how to invest and the strategy to invest in, you know, and how to do all that, it's becoming a pillar. And if you aren't thinking about the taxes, you know, take a look at your balance sheet. You know, realize that is the largest single item on your balance sheet. You know, if your personal sole prop and you're making 250 grand, you know, largest item you have. If you're in a corporation, you're making over 500 grand, you know, maybe more, but like, you know, huge line items. Like, it is worth your time to sit down and talk to a professional to get it done professionally, even if it does cost you like $10, $15, $20,000. I can guarantee you, if you're paying that amount, you're probably going to save a significant amount more doing it properly.
Well, you don't want to do it improperly either. Like, nothing like getting reassessed and then having to go back through it all. Like, I mean, not that, you know, you could still do it properly and still be reassessed, but you know, your chances of being reassessed go up that much more if you know, kind of half-ass it or don't go through it with like an appropriate, you know, someone who understands what they're doing or understands the intricacies of your business. So definitely.
Yeah, it's a conversation I have very often where people are on the fence and they've always filed their own taxes or done their own bookkeeping. And now they're kind of like, do I spend this extra money per year for planning, for filing? My life's gotten busier, that the asset base has grown, my business is blowing up. And so you need to make that call at some point to realize, you know what, I do need some help here. I don't know what I don't know. And unfortunately, the Tax Act in Canada keeps on getting more complicated. It's good for us accountants, and there's a shortage of accountants. That's why I tell young people, even with all the AI stuff and everyone's looking around like whose job is going to be taken, I think there's just so much opportunity where you start off in like moving into finance area and learn about all of the topics that all end up with taxes in some way, shape, or form. Not only is the Tax Act getting more difficult, but all levels of government are coming after us with property taxes, taxes at the store, on cars, on everything that you do and earn. So I think it's our duty, you know, within the rules to understand how to minimize that hit on your balance sheet, on your income statement.
Well, everything ends with it. Doesn't matter what you do in the world. Taxes is the one thing that's going to be 100% present across the board. Like, it's always going to be there.
Wasn't it Warren Buffett who said you should pay exactly what you should pay for taxes? Like, in regards to, you know, at least in the States, you have a lot more options with, you know, Delaware Corporation or opening of different corporations in different companies or like states. But, you know, if you are going to be oblivious to the tax code and not understand it or have people understand it, then you should pay what you should pay. But if you understand the code, you understand you have the resources to be able to navigate that, then you will pay what you will pay, you know?
Very true. Yeah. And there's been a number of clients that feel like they're paying too much at tax time. And I kind of run a summary, especially first year clients that I'm educating, I'm kind of bringing them up to speed with my process. I literally run the numbers and I say, you just collected 100,000 in income. You also collected 13,000 in HST in Ontario. And now I'm telling you that you owe, you know, 15,000 in taxes, which is a huge number to them and to most people would be, but they haven't paid a penny in taxes all year. And they owe, let's say, 7,000 in HST. So of the 13 they collect, they're only having to remit 7. So now, you have to pay 20% tax for making all this money that you paid nothing on during the year. You've been able to use it, to reinvest it, to buy assets with it. That's a small price to pay, right? When you break it down. But a lot of people are just looking at the number, and it's hard to kind of get through their head. And they also need to realize they are now successful business owners, and that number's probably going to go up. So let's get ahead of this, because now you're probably going to be paying installments for the next year. You're going to have to get on that schedule with CRA.
I think it's a hard thing for the average person to process when life just continuously gets more and more expensive. Like inflation's up, taxes aren't definitely going down. It just feels like you're kind of getting hit like every which way, and then even at the end of the year, like 15 grand, yeah, but they're like, yeah, but all this other stuff. And then, I have a little bit of success, and it's just like, here, let me pay back the tax and everything that I've already kind of paid taxes on when I go and buy stuff. And it's just like, I understand why people get frustrated,
It's
for
true.
sure.
Yeah, one of the biggest surprises for me in the years that I've been practicing always continues to be how difficult it can be for people to make those tax payments if they haven't been actively saving and putting money aside for them. And usually when I start working with them and we kind of estimate, like based on this year and the last 2 years, how next year might look for you, I tell them you need to put aside, if you're not paying installments yet. If you are, it's a little bit easier because the CRA literally forces you to give them a payment every quarter, because they're assuming you're going to make the same amount next year and pay similar taxes. But for others, like I tell them, hey, like HST, GST, HST that you're collecting, it's not really your money. You're just a tax collector for the CRA. So don't assume that you can book that trip to Cuba or Mexico and
It's
use
not
that
yours.
10 grand. Like that should be in a separate account. And I think that kind of mindset change really does help people for future years.
Do you have some general numbers for business owners where, if you're making within 250 grand, like how much would you recommend just kind of putting aside? Like, do you have any like kind of basic guidelines for them from that sense?
If I had to ballpark it, 30% is a good number when you factor everything in. But it's really kind of the hardest time is that transition. It's that first year that you have the big jump, because that's when you realize, oh, wow, I've had a number of realtors. First time they made 300 grand, let's say. And they've always been around 100. Now we do their personal taxes, and they owe like 120 to 150,000 between personal and HST. All depends on how much credits they have, childcare, spousal credits, donations, RSPs, things like that bring it down. But like they're paying 6 figures. So once they pay that big amount for the first time, now CRA is going to tell them, hey, you owe us installments. So if they get on that schedule, it becomes easier. But using last year as a guide is always a good idea. For the folks that are, smaller income, self-employed earners, 80, 100, 120, putting aside 20 to 30%, you can't go wrong with that. I know it's not easy. I've had so many business owners tell me, like, I'm working so hard. I make all this money. Then I come to you at tax time, and I know you're literally minimizing my tax owing, but there's nothing left.
Like
Like,
a
how do I
dentist.
get by? It's tough. I feel like a shrink sometimes because I'm helping them, understand taxes and minimize the taxes owing, but also consoling them and letting them know, it's going to be okay. Like, there's only so much we can do, but you're
requesting a
doing
shot of
well
tequila
as
at the
as
same
a
time, just
as a business operator. They're doing well. It just everything kind of around us. It's not easy these days.
Well, I mean, you can there's things you can do to combat that, right? Like understanding what write-offs look like for both, a sole proprietor and, in a corporation, like to the maximum of extent of, your ability within the lines of, what CRA allows. Understand what that looks like. Can you write off a part of your house? Can you write off the utilities of part of your house if you're going to be using it as as an office, a company car, what does that entail? Like, there are obviously advantages, but as you said, strategy, if you're a sole prop and you're making only 120 grand a year, you need to use all those to be able to offset the tax burden, or else you're not going to be able to get ahead. Unfortunately, the government's been printing money, massively high inflation over the last 2 years. 120 grand is, the $80,000 of what it was 2-3 years ago. The 100,000 now, you need to make, as a family, making $200,000+ a year to be able to take on, everyday costs, which can become challenging and creeping up. So reverting back, it always makes sense just to talk to your tax accountant about, using the tools that you have, because again, you will pay what you should pay, right?
Totally agreed. Yeah, it's not easy out there these days. Too many people are kind of just paycheck to paycheck, even with two six-figure T4 salaries. Once you factor in kids and regular expenses, one or two vacations a year, the car payments, the mortgage. That's why I think like a lot of respect goes out to people that have been able to build at least a small portfolio. Many of my clients have, I'd say, 2 to 3 rentals, and it's nice to see that. They're still holding on to the stable jobs. A lot of them are trying these days, I've noticed, to maybe kick off another active income business, bookkeeping, construction, something else that they're skilled in. I always remind people as not as an accountant, but just as a business owner, don't jump into something just because money could possibly be made in it or somebody else is doing it and they look profitable. It's got to be something that aligns with you and that you enjoy, because otherwise you're going to drop it in a year. Like it's not going to be lasting. It needs to be something that is going to, bring value to your life. And if it is, and you become successful, before you know it, that's hopefully taking the place of the T4 job down the line.
Yeah, it's always tough to make that jump, but you never follow the money, always follow the passion, and the money will follow. As long as you're the best at what you do, you'll always have business. That being said, you also invest in real estate. You're a coach. You've been a coach for quite a while. I think you were coaching with Corey for a while, if not still coaching with Corey.
Yep.
Talk a little bit about that. Have you been investing? I think last time I saw on Instagram you were looking at active businesses. What are you up to?
Yeah, you know what? It's been an interesting journey. We did a lot of long-term rental BRRRRs. I'd say 5-6 years ago is when we started, and so I felt like I was in rental mode for probably 3-4 years. There was like 2-3 BRRRRs. We were adding legal units. We pretty much renovated every unit that we own in a long-term rental portfolio, mostly in the Niagara region. And I'd say that kind of silo, that bucket is pretty much under control, knock on wood. We have a great property manager in place now. I only need to jump in when there's decisions to be made because an appliance breaks down or a furnace or an AC. But otherwise, it's kind of just ticking away there, the long-term rental side. We have the cottage up north. Also, from my systems-based approach and the way that my mind works, made sure that we set up good processes there. We have a great cleaning crew. We actually bought the cottage as a new build from a local builder. Before closing, I made sure I got his HVAC guy, his plumber, his electrician, because it's hard to find good trades up north. So feel like I have a really good power team up there. Well, we self-manage that. I self-manage it. So that's also like a kind of business in a box on its own. And now here, within the tax business, I initially started when I was coaching with Corey. I hired Corey as a coach, and that was great. He was a mentor to me. I really got to see how he runs his business and portfolio in the back end. He runs a property management company as well. So I took a lot from that. Then he brought me in after a little while as a coach. So I was able to really sharpen my skills in terms of teaching and educating and, making sure that others learned what I knew. And so I've applied that in the tax business. But before I really formally launched a tax business about 3 years ago, I was looking at active businesses. We were looking at campgrounds, trailer parks, buying accounting firms. And at that point, I realized, the simplest and easiest route here is to just start my own practice. My own practice, I can grow it and scale it when I need an admin assistant, an EA, or a junior accountant. When I get busy enough or too busy, I can hire. I can do it my way. I'm not, bringing on any liabilities or things that come with buying a business. So that's kind of how this thing grew. And this is where most of my time goes right now. While the rentals are kind of taking care of their own in the background, I'm focused on growing the tax practice. And it's just, I enjoy having conversation, just like we're talking today. Somebody's always reaching out, a new client, a referral, somebody, is behind a bunch of years and they need 6 years filed this week. I've had that a couple of times. But just people want to talk shop. They want to talk tax and strategy. And by default, I'll look at their taxes, their previous year returns. I'll give them a quote for next year's filing, but then I'll maybe spot a couple of things and I'll mention, hey, like, I noticed you don't have any vehicle expenses here. Are you tracking mileage? Because that's actually one thing that many people do not do well. So if you're trying to maximize expenses, you want to be putting in vehicle expenses. Can't do that without knowing what percentage your mileage is for business, whether it's 1 or 2 cars. Office expenses are missed often, right? So if you're not tracking all the utilities for where you live or an office that you rent, like, we definitely want to put that in. Depreciation is a great last option to minimize expenses, but yeah, I'd say the tax practice is my baby right now. We spent years building up the asset base, put that kind of aside now. But I feel like everybody goes through seasons.
Yeah.
And so we're going through a season of let's focus on the active business, grow this thing. And, when the right opportunities to purchase more assets or partner up with other investors comes along, we'll be ready and willing to jump back into that.
I think it's a great strategy. A lot of the I think there's a misconception that you can get rich in real estate. I think you can get rich owning an active business that you can invest in real estate that will eventually make you wealthy. Obviously, there's active strategies around real estate, but it's not very it's very market dependent and strategy dependent. So, I love that you're double downing on what you're doing and what you love and what you're good at. And I think there's a massive gap in the market, for good advice, real advice, not from a big 5 accounting firm that's just there for the dollars, but somebody who has built a portfolio or who's done the JV agreements or who has, gone through the challenges with, owning real estate and owning a business, especially for somebody who's, business for self. Like it can be like a very heavy, thing to have to deal with on top of trying to grow a business and, drink your water and mind your business and be happy and, live a lifestyle as well. So like I'm glad that you're doing it. I think it's important that that there is a service like that out there for people. If people did want to reach out to you, how would they go about doing that?
Yeah, I'm most active on Instagram at Watch Properties, WACH Properties. You can find me online. I'm kind of rebranding to Watch Tax Services, but if you put in WACH and anything related to tax, I heard there's some posts on Reddit about me, so I get some referrals from there.
Love it.
I'm on Instagram, on Facebook, I have a website online too. So Watch Properties can't go wrong if you reach out in those places.
The man's internationally known. I love it. Well, Mike, appreciate you coming on. I think it's something that everybody needs to hear, and the breath of fresh air, knowing that there's a light at the end of the tunnel. If anybody does want to reach out, you guys have the contact information. Mike, really appreciate you coming on.
Awesome. Thanks, guys. Appreciate it as well.